Hey everybody, Courtney Smith here with our weekly video newsletter, TradeSmith. As always, lots of action. Most of the most important action, of course, is this disclaimer here, and there's lots of action in there, that's for sure. So let's take a look and see what we've got here. Well, first of all, the S&P 500 is still in this trading range inside this rectangle formation that I've been talking about for a while. We're up at the top of that range, and I think we're going to probably head lower. Look at that orange line I've put there. That line shows that the on balance volume did not make a new high when the stock market did, and that divergence suggests that we're going to sell off here pretty soon and head down towards the bottom of that trading range, down a little above 2020, let's say 2025. So that's the outlook right now. We're at the top of the range. Now we're going to go down to the bottom of the range. Dow, pretty much the same story, only not as strong. It's really been the NASDAQ on this chart that's shown the strength. So for months and months and months, we were in a period where the Dow and the S&P were much stronger than the NASDAQ, but the NASDAQ did a lot of catch up this week, or I should say over the last 2 weeks. But I have a feeling it's going to go back to the S&P. Well, we'll see. Okay, seasonality is a bullish factor. It's showing here we rallied strongly after hitting that green line back in the middle of May, and now we're way up at new highs. So right now it's going to take us quite some time before we turn from bullish to bearish. And so in the meantime, we've got to be extra aggressive in terms of the size of the positions that we put on. So when the seasonal indicator is bullish, we put on bigger than normal positions. If it's bearish, which it's not right now, then we look at the more conservative, maybe half a size, half of our normal position. Okay, yield curve. This is pretty interesting. So the yield curve is a 1 year forward predictor of the stock market. Now here we are, we're at the high of the yield curve. I've got an orange arrow there pointing to where we are, and this is 1 year ago that we were at this level. And as you can see, the yield curve went down a lot in the last year, particularly early this year. Now that doesn't mean we're going to have a bear market. No, but what it does mean is we're not going to see the kind of strength. We're not going to see a big bull market. We need, in order to be a bear market, we need to see this turn to negative numbers. Right now, we're at 140, so that's very positive. So no bear market this year at all. You can ignore the doom and gloomers, but it's not going to be a big bull market either. We're going to struggle this year. Asset allocation, pretty stable. They're trying to figure out if they want to be in stocks or bonds. You can see just in the last week, this indicator went down, showing that money went out of the stock market and into the bond market. Wait till you see the bond market chart in a minute. Unbelievable. Risk appetite also turned down a little bit, but it really wasn't rallying that much. So really, what does this tell us? Stock market investors are kind of still staying pretty conservative. They like the utilities, they like conservative stocks. Global shares are starting to perk up. Not perk up enough that I want to get involved in this market though. But nonetheless, we're starting to see some bullish action overseas. They are easing monetary policy dramatically overseas in Japan and Europe, and that's supporting these shares. Now the one that I like the best, which I've been highlighting, is the Greek market. Look at this thing. What a bull market. Up 60% or so from the lows. Insane. Up 20-30% from when I first told you that this is a great market to be involved in. This is going to surprise, well, it's already surprising everybody about how good the Greek shares are doing. Wait a minute, they have all kinds of disasters and IMF and debt. Yeah, but everybody knows all that. Now, there's really only pretty much good news in the Greek market. So this is a surprising one, but this is one of my favorite trades. Here's that bond market trade that I was talking about. Look at this thing. Gapped above the top of the rectangle formation on heavier than normal volume. Not super heavy volume, but at least heavier than normal. This is a pretty powerful looking chart at this point, okay? I've been talking about this for, gosh, it might be a month or two, about this rectangle formation, and that we were going to stay in this rectangle formation. But if the market were to break out of the top, I would be a buyer. If it broke the bottom, I'd be a seller. But I'm going to go back on that, and I'm not going to be a buyer quite yet. Give me another week. Here's why. Our indicators are still a mixed bag. There's some of them are going down, some of them are going up, some of them are going sideways. Now, there's a little bit of a bias towards the bull side, but not much. And so what I'm afraid of is that since the indicators are pretty neutral, that what's going to happen is that we're going to see the market go back into the trading range that we were in. So I need to wait a day or two. Are we going to fill that gap? Are we going to go back into the trading range? Because the key indicators are not supportive. They're not supportive of the bond market at this point. Bonds are moving higher because they expect that the Fed is not going to raise interest rates. Heck, I don't think they're going to raise interest rates till December, if at all, this year. So I've been an outlier last year. I said that they weren't going to do anything. I was right on the money. This year, I'm telling you, they're really not going to do anything before December. So the bonds are at a critical point here, and we need to be watching them. I need one more week to get clarity. How are they going to react at that gap? The dollar, on the same news, which was the non-farm payrolls number on Friday, collapsed because the thinking is, now the Fed's not going to raise interest rates, so why be in the dollar? And that's a pretty good idea. Market fell down very, very hard. We have to respect the size of that move. But we need to watch it once again for another week, because if the bonds go back into the range that they were at, we're going to see the dollar rally. Right now, got to be on the short side, though, of the dollar. Gold, of course, had the opposite move, sharply higher. Was that strong volume down there? I don't know. Wasn't that strong. So we have to respect the size of the bar. But once again, we're just in a big trading range, a big rectangle formation. I think we're going back up to the high end of the rectangle at 1300. So for some of you, that's a tradable move. But right now, I'm going to stay on the sidelines in the gold market. Our indicators, though, are all bullish now. This is the first time they've been all bullish since April. So this is pretty good. If we can, let me go back to this chart. That tells me I'm very confident that we're going to go up to 1300. Are we going to break through? Let's take a look when we get there. So some of you who are aggressive, I'd recommend getting into gold right now. More conservative investors, we should wait for a break to new high, and we should make sure that our key indicators remain bullish. Oil? Who cares? It's been sideways for 2 or 3 weeks. One of the things that you see the little red lines, that shows a momentum divergence, but we might have solved that problem. Really, this market's not going anywhere in the context of a major bull market. All right, everybody. Thank you, all you freebies. Love having you here every week. Love to see you on all my new iTunes people. We've got this put up as a podcast now on iTunes. You can subscribe to it. It's absolutely free. That's a great, convenient way. Of course, tell your friends. But on the other hand, we'd love to have you as a paid, fully paid up member. It's a peanut, and you get so much more. All right, everybody. Thank you, all you freebies. Fully paid up members, hang in there. Got some interesting stuff.